Even though we see ourselves as completely rational individuals, our brains are programmed to react to events. This is especially the case with the stock market, where events happen all the time. Anything which promotes a reward, such as a rise in the value of our investment, affects the neural pathways in the brain and releases endorphins, chemicals which induce feelings of pleasure. These feelings can become addictive. But the downside is, when our shares fall, the opposite happens, a dip in the endorphins, leading to a feeling of gloom and despondency. But how do emotions affect the way we invest? Research has shown that we feel the pain of losing twice as much as we enjoy the thrill of winning. So if the promised gains are twice the potential losses, we are attracted. If we are told our £10,000 investment could be worth anything between £5,000 and £15,000 in 2 years' time, we might not be interested. But if we focus just on the potential gains and ignore the possible losses, we are more likely to go for it. On the other hand, our emotions can sometimes make us too scared of risk. We'd rather know for sure how much our money will be worth in 2 years than take a chance that it could be worth a lot less. So sometimes we put too much focus on less risky investments like bonds, for example, and miss out on market returns by playing it too safe. In fact, the FTSE All-Share Index has only fallen for 7 out of the past 40 years, returning an average 12% over that time. There's also the fear of regret, that we have bought something we could have got cheaper. We don't invest at £10 a share only to find it falls to £9 the following week. We want it to go up as soon as possible to confirm that we bought at the right time. This means we might wait until the share price falls before we buy. But what if it goes higher? There is never an ideal time to buy or sell because we don't know in advance when the market is going to peak or bottom out. And finally, and perhaps most harmfully, we are all subject to the bandwagon effect. We are tempted to buy because everyone else is, or our friends give us a tip on the next big thing. We pay too much attention to the financial media, which is funded by advertising from active fund management companies. But just because other people believe something is right, doesn't mean it is. Our investments can gain 1 year and lose the next, but we have no way of knowing beforehand which year will give which result, despite what other people tell us. The fact is, over the long term, we only have a 3% chance of beating the market year after year, about the same chance as a number coming up in roulette. History shows the big stock market gains are concentrated into just a few days each year. According to a recent US study, frequent trading means we could miss those days and halve our returns over the long run. Emotions, other people, the media, and the market itself all serve to distract us from the business of investing. Evidence-based investing removes emotion from the investing process and forces us to stick to a proven strategy that's about preserving and growing wealth, not about the stock market. Accepting the theory that markets are efficient can be transformational, not just for our wealth, but our emotional health too.